majorly the risks are classified into two major categories. One is financial and the second one is non-financial. Types of risk, financial risk and non-financial risk. What are all the major products? Deposits and advances, loans and advances. So whatever the risk is coming across in the banking business, under this credit portfolio is credit risk. Suppose you have given a loan to a corporate customer. This corporate customer's grade has come from AAA to BB, AA to BBB, like that. That deterioration of assets happens. Conservation of capital is the next key topic which we have to discuss about and concentrate more on that. So, Peter Drucker's principle of risk management. So, there is a famous saying. So, the Peter Drucker saying is that identify all the risk in the business and classify them into risk that you can afford to take. As I said, you cannot avoid all the risk. During these competitive days, you cannot avoid. You cannot say no to all the proposals which is coming in front of you. No, you have to see what are all the risks which we can afford to take. That is what he says. Identify all the risk in the business and classify them into risk that you can afford to take. Then risk you cannot afford to take. These two categories. You cannot afford to take means you have to simply say that no to that particular business. No. There is a big no here. Some risk you have to take. Now, when you take the risk, do not take the risk that you cannot afford to take. You cannot afford to take the risk means simply a big no to such proposal. Do not fail to take the risk that you can afford to take. That is what Peter Drucker says, that do not take the risk that you cannot afford to take. Do not fail to take the risk that you can afford to take. You have to take admissible risk and address the risk and make profit. So, stages in risk management. So, we have discussed about all these things: risk identification, measurement, monitoring, mitigation. In between these things, there is one thing we have discussed is risk pricing. Risk pricing. Pricing. So, in addition to these four major risks, you have to do the pricing also. You have to factor that risk component into your pricing and you have to generate profit. You should not lose interest because of your risk-taking appetite or capacity. You have to take the risk, price it and recover it. That's it. So, what are all the objectives of risk management? Efficiency in operation, that is what we discussed in the first session, that is the act efficiently, uninterrupted operation. It should be a continuous process. In whatever the units which you finance, you should see that the operations is uninterrupted. Like in our banking industry also, there should be an uninterrupted operations. Continued growth. For risk management also, uninterrupted operation, all the process, identification, measurement, pricing, monitoring, control, reviewing, etc., and mitigation. So, there is uninterrupted operations, processes should be there in risk management also. And then minimize the risk, preservation of reputation. These are all the steps involved. Then stages in risk management is identification, measurement, all these things we discussed. Then process of risk management, identification, assessment, starting with the quantification. That is what the 5 C's we have been discussing yesterday. 5 C's about character, capacity and all those things. Then the analysis part, the past financials and historical financials and the future projections. Then you report everything, whatever you have noticed, the qualified report, everything, remarks by the auditor and the audited financial sheet, everything you have to report it. Then the capital allocation, risk management, the process, all those tips, identification, from identification to mitigation, all these tips. This is a cyclical representation of the risk management process. Types of risk. What are all the major types of risk which we will be discussing in the coming sessions? The risk majorly the risks are classified into two major categories. One is financial and the second one is non-financial. Types of risk, financial risk and non-financial risk. Financial risk, what is the financial risk? Whatever the risk, so you are coming across, if the risk affects your profit, your P&L account, of course it is called a financial risk. There will be a loss of your profit, there will be a reduction of your profit. Whenever it affects your P&L, there will be it is called a financial, simple, it's called a financial risk. So, the financial risk and non-financial are the major two types of risk. Under the financial risk, what we have discussed is credit risk, market risk and operational risk. So, why these three risks are most important? Because all the three risks we have to quantify the risk and we have to keep capital. So, the financial risk mainly three types: credit, market and operational risk. Non-financial, the business risk and strategic risk. So, when we discuss the risk in detail, we will discuss what are all the business and strategic risks. Then under this financials, everything, liquidity, of course, it is also financial risk, because unless you manage your liquidity properly, it will affect your profit. Exchange, interest rate, equity, commodity, everything comes under this financial risk category. So many types of risk are there, majorly financial and non-financials. Then the credit risk in detail. Credit risk. What is credit risk? Whatever risk happens in your banking book of accounts, in your banking transactions. What are all the major products? Deposits and advances, loans and advances. So, whatever the risk is coming across in the banking business, under this credit portfolio is credit risk. What are all the types of major types of credit risk? Credit default risk, concentration risk, country risk, bankruptcy, downgrade, settlement. So, majorly these 6 types of risk. Mainly, credit risk is mainly it is default risk. Default. That is what we discussed, the default. So, default is nothing but the expected loss. That is what we discussed in the previous session. Expected loss. That's a risk we have to identify. So, default risk is a credit risk. Default risk is a credit risk. Default risk is otherwise termed as expected loss. Expected loss comes from the probability of default and also the exposure at default and also the loss given default. These 3 factors are there for this expected loss. Default. How to quantify, measure the default is from this. That is what we discussed in the previous session. Expected loss. So, credit default. Default risk is a credit risk. When the default comes, the customer is not paying properly on time, is repayment is not coming into effect. So, when the repayment is not made on time, there comes the default risk. You have to quantify the default risk and you have to keep capital. Then the concentration risk. What is concentration risk? All eggs are put in a single basket. You are concentrating on a single product or a single one segment. It is open to concentration risk. When you are putting all the money in the real estate sector, when something bad happens in the market in the real estate sector, so entire money will be in danger. Your exposure will be at a default. So, there will be a concentration risk. You cannot concentrate on a single product. So, you have to do diversification, diversified investments. You have to go for different investment. You have to do a profit planning. You have to put money in different baskets. All the eggs should not be put in a single basket. You have to put the eggs in different baskets so that your risk is reduced. That is the concentration risk. Country risk. The country risk, whenever some transactions involves when the counterparty is in the other country because of ban and some government directives and all those things, when the settlement doesn't happen on time, there will be so many risks. That's country risk. Bankruptcy. You are keeping capital, you are incurring losses repeatedly. So, from where the losses are absorbed from the capital, then slowly your capital will be eroded. That erosion of capital will lead to bankruptcy. So, repeated what you call the increase in risk percentage, whatever it is, credit risk, market risk or operational, whatever risk, when the increase in capital, increase in risk happens, you have to maintain capital. In that process, the capital, if you are not able to maintain adequate capital, your bank will be at a risk. So, there may be a risk of bankruptcy. So many factors are there for bankruptcy risk. Downgrade risk. Suppose you have given a loan to a corporate customer. This corporate customer's grade has come from AAA to AA to BBB, like that. That deterioration of assets happens. Not only in the asset side, your internal procedures, whatever it is, getting downgraded. you will be open to downgrade risk. For under this credit risk, whenever you are given a loan to a customer, if he is downgraded to a downgraded risk category is more, you have to keep capital more, ideal fund you have to keep it more, the risk will be more. Then the settlement risk happens. When two counterparties are involved, the one party fails to settle the funds, there will be a settlement risk. Like that, so many risks we will be discussing under this identification of risk. So this is coming under all these types of risk comes under the identification of risk. How do you mitigate the process? Once you identify, you have to quantify. Identified, you identified as default risk. Then you have measured expected loss. You measured. Then you priced. You have to price the risk. You find that okay, 0.02% is your price component, risk component factor. So you have added along with this one. So housing loan interest is suppose 7%. So the risk factor you have added 0.2%. Then the new pricing will be 7.02%. This is the risk pricing also, includes the risk pricing also. So the third step is also complied with. Then you go for the monitoring and control. You have keeping on auditing the files every 6 months. You have audited that big exposure. You have called for the interim financials. You have done the review of that particular unit. You have done the renewal process have been done. So all these type of things is the continuous monitoring and controlling the risk. You are calling for more security percentage. You are telling that you have to keep more margin, or you have to infuse this net worth. Some capital has to be infused because your exposure has gone. You have to bring in additional funds. All those things comes under the what you call the monitoring and control processes. Then finally what you have to do is mitigate. You have to reduce the risk. How do you mitigate reduce the risk? Mitigation techniques. That is more important. So you cannot, as I said, you cannot avoid risk. You have to accept the risk. Whatever risk you can afford to, you have to take the risk into your books. When you take the books into your books, you have to see that the risk is addressed. The risk is monitored, the risk is controlled, the risk is mitigated. So mitigation is by way of so many things. Credit risk based pricing, that is the pricing which we have discussed here, the pricing. So that is also a mitigation process. Credit insurance, you have transferred the risk to a third party. Prudential limit. Suppose your housing loan segment, you are putting up a limit that, okay, so for under these things, 100 crore is the limit. Beyond that, we cannot go. For your JM1 officer or MM2 or senior level officer, you are fixing that this senior level manager can sanction a limit of 100, he can sanction up to a 100 lakhs. Okay. So that is the limit which he has. Then you can say that 20% you can sanction as an additional ad hoc limit. That is the sanctioning power limited to that particular officer cadre. Like that for segment, sector, product, everything, there will be a limit. Prudential limit will be there. Beyond that, you cannot go. If it exceeds that prudential limit, there is a risk. So fixing a prudential limit is also one of the mitigating techniques in risk management. So risk rating. So for all these corporates beyond the 7.5 crores amount, so we are doing that risk rating process. The risk rating is done for all corporate accounts. So AAA, so CRISIL Care, all those things rate AA, triple B, like that, the rating continues. So risk rating is done. Based on the rating, we fix the pricing. Based on the rating, we take an exposure. Based on the rating, we put the covenants, conditions, etc., as a monitoring, controlling, and mitigating techniques part of. So like that, the risk rating is also part of mitigation techniques. Portfolio management. Instead of putting this one in a single product, the entire portfolio is managed together, so that if it is affected, one particular the exposure is affected, the other thing also there is a chance of affecting the other things. So the entire portfolio is managed together to address the risk. So portfolio management is also one of the mitigation techniques. Loan review mechanism. We review the mechanism. Loan review. All the loans are reviewed periodically. Based on the exposure, we do 6 months review, 1 year review, like that. We call for the interim financials. We go and inspect the units. So interim review is done. Loan review mechanism is also part of mitigation techniques. Diversification. As I said, we are not putting all the eggs in a single basket. We put different products. We take exposure in different segments, like personal segments we do. agri segments, retail, SME, MSME, corporates, like credit cards, all those things we take exposure. Then committee-based approach, that is also a risk mitigation. Committee-based, we have different committees for managing, monitoring risk, various kind of risk. So many committees we have. We have Credit Risk Management Committee, CRMC, Operational Risk Management Committee, Asset, ORMC. We have Asset Liability Management Committee, ALCO. All these committees will take care of the mitigation techniques. They will periodically come out with the solution that this is the exposure, is going beyond our risk appetite. You have to adopt this strategy ABCD. So these are all the risk mitigation techniques which we use. So techniques and tools for credit management, loan review, that is what we have discussed now. Just a loan review mechanism, portfolio, analytics of risk detection, pricing, rating, prudential limit and credit approving authority. These are all the techniques and tools for credit risk management. This is mainly for credit risk management. Then comes the market risk. Market risk, what are all the types of market risks? Mainly, there are three types of market risk. That is, interest rate risk is the most important risk which the banker has to address. Interest rate, because we are taking an exposure in different security products, instruments in the market, bonds, shares, etc. When you take an exposure on such things, it is open to volatility in the market. Depending upon the market conditions, the volatility also, there is a wide fluctuation in the interest rate. That is why we do the analysis, the assessment of this portfolio on a day-to-day basis called the mark-to-market basis. In the banking book of accounts, the accounting procedure is accrual basis. We apply interest and take in the exposure, everything we calculate based on the accrual basis. Apply interest on accrual basis. First 30 days, we take 30 days. On the 30th day, we apply interest. But how do you assess the exposure on market instruments on day-to-day basis? That's called mark-to-market. So, such exposure is open to interest rate risk. When the market interest rate comes down, what will happen to our existing? For example, we are holding a bond value of 100 crores. The bond value is 100 crores. The bank B is carrying a bond exposure on a bond 100 crores. So at that time, the coupon rate is 4.5%. So when the market rate goes up, so the 4.5% market rate today has gone up to 5%. The existing bond holder, what is the price? What will be the impact on his existing bond price? The value of this bond price has come down. So whenever the market rate goes up, the existing bond price value will come down. That's the bond rule pricing. So the pricing of bond is the rule of pricing the bond is like that. Whenever the market rate goes up, the existing bond price holder's value will come down. Like that, it is open to interest rate risk. So whenever the market rate goes up, it will affect adversely or positively the market holders, the shareholders or the bond holders pricing pattern. So we are open to, our exposure will be open to depending upon the fluctuation or volatility of interest rate in the market. So the interest rate risk has to be addressed. That is the most important. Then of course the currency risk also, we have to address the currency risk. Because there will be a wide fluctuation. Today the USD pricing will be the 85, tomorrow it will be 84, like that. So the currency rate fluctuation we need to address. Price risk also has to be addressed under this market risk. Mitigation taxing, again the cap on market exposure, then cap on interest, interbank borrowings, again the prudential limit. You have to put some limits for particular investments. Okay, oil and gas industry, the shares you have to take this much exposure only. Beyond that, you cannot go. Gold purchases, you cannot go beyond that limit. Some limits you have to fix. Use of risk mitigation instruments of market. So many instruments are available under foreign exchange. You have gone through all those things of derivatives and all those things, interest swaps, forwards, etc. So the mitigation techniques you have to adopt for market risk. Then next one is operational risk. So credit risk, what are all the types of risk? Then how do you mitigate the risk? Then market risk, what are all the types of risk? How do you mitigate the risk? What is the major techniques which we use to mitigate market risk? Then comes the operational risk. Operational risk, what are all the major types of operational risk? Internal fraud can lead to a operational risk. So your exposure is affected due to internal fraud. External fraud also one of the reasons. Employment practices and workplace safety, clients, products and business practices, damage to physical assets, execution, delivery and process management. All these things happens because it affects our systems and procedural failure. It may lead to failure of our systems and procedure and the products will be affected. So, we will be facing operational risk. How do you mitigate the operational risk? Clear policy and procedures, knowledge and role clarity, experience, judgment, intuition, etc. So, these are intuition. Then regulatory requirement, insurance, monitoring. These are all the mitigation techniques applicable by other risks also. Insurance we do for credit risk also, market risk also, monitoring, regulatory requirement, intuition, judgment, experience, knowledge, clear policy and procedural guidelines. Unless you have the clear policy and procedure, you will be having this. You have to face operational risk also. So, the mitigation techniques of operational risk. Then, capital conservation. The need of capital. Whenever you identify the risk, you have to assess the risk. Then you assess the risk, you have to quantify the risk, you have to keep the capital. What is the purpose of keeping capital? What is capital? Capital is the source of funds. So the first one, as we discussed in the balance sheet structure, in the left side source of funds, the first one is capital. So where do we stand? We need to find out what is the percentage minimum capital required. RBI says that 9% of your risk weighted asset should be your minimum capital. So what is the percentage? Whether we have followed, whether we have complied with the regulatory guidelines or not, whether we are concentrating on this management of capital, maintenance of capital, etc. So where do we stand? What is the percentage presently we hold? How to conserve capital? So, the capital, the importance of capital is described under these topics. So, capital and its function. Capital is the money contributed by promoters in the business. It may be in the form of direct infusion of money or may be in the form of reserve and surpluses. Loss absorption function. So, it is to absorb any losses. Whenever some losses happens, the first thing we have to rely on is, okay, this much capital we have. So, we are safe. Like that, to work as a cushion during critical time for business. That is the purpose of capital. Lending function. So, to conduct the business, so what this much percentage you have, then only you can lend out this much percentage as loan. So, to maintain, to do a lending process, you need to keep adequate capital in your books of accounts. So, lending function also is one of the functions of capital. Benchmark function, of course, RBI says that 9% should be your benchmark. To act as a benchmark to measure the returns in business. As I said, RAROC, risk adjusted return. Even after adjusting the return from your profit, you have come out with a sufficient quantity of risk adjusted return. It will tell you the financial stability strength of that particular institution. That's a benchmark function. To act as a benchmark to measure the returns in business, it also acts as an indicator of net worth of the bank. Confidence function, to showcase the strength of business to shareholders, stakeholders and investors like depositors. Depositors will come and see the capital base. What is the net worth of your financial institution? Then they will be seeing that, okay, this financial institution has financial stability. I can very well put my money into this financial institution. I will be safe on seeing that this capital position, how much capital this institution has. That's why it's called a confidence function. The capital also has then compliance. Okay, 9% RBI says we have 11.5, we are in safe position. So, compliance also, to meet the regulatory requirement also, it is one of the functions of capital.